Today, folks, we're diving down into 4 Canadian dividend stocks yielding anywhere from 5 to over 6% dividend, some of which just increased the dividend on the recent earnings report, which all of these had blowout quarters. We're seeing the markets rally back today as well, thanks to the jobs report numbers coming out of the US and Canada, as Canada posts blowout job gains in October here. The economy added an extra 108,000 jobs last month, easily beating the forecast of 10,000 new jobs, and the jobless rate was unchanged at 5.2%, driving the TSX up from those recent lows of October, guys. We are trading up 7%, only down 8.3% year to date against the S&P 500, which is down 21%. So let's get into these 4 stocks with, first and foremost, my favorite real estate investment trust of all time, of course, being RioCan, which isn't rallying as much today as I would have expected off the earnings that they dropped. And we'll take a look at those earnings, but look at the presentation that they dropped here. They're seeing committed occupancy continue to rise since the pandemic lows, now at 97.3% occupied, and the rent per occupied square foot, something I've talked about, rents are going up across the board, whether it's office, retail, residential. So we are seeing the square footage on the new leases drive up the overall portfolio of value per square foot. Now, taking a look at the tenant basis here, guys, every time I look at this, I get giddy inside. I mean, take a look at this, because 60% roughly of the tenants are all these foundational things like Costco, Walmart, Loblaws, Canadian Tire, Scotiabank, TD. These are just a really robust tenant basis, in my humble opinion. I really like these companies a lot. From the base rent perspective here, they went from 168 million last year to 174 million this year. On the 9-month, it's nothing too crazy, 511 million, 516 million here. It's nice to see that this is trickling higher, and this is a company that had cut its dividend, and we're not seeing any more dividend increases come out of it. The current payout ratio is around 55%, I believe, and they're going to be making about $800 million over the next few years off their condo projects that they're going to primarily be reinvesting into growth. I don't think they're going to be raising the dividend, but hey, they're not diluting shareholders. They're going to continue to cash flow off projects, and they're looking to expand the portfolio continually. So I think they're in a much more healthier position than a lot of REITs that I've been recently looking at. But putting RioCan aside, we also had Enbridge earnings today, folks, and this one actually bumped up pretty nicely. Was trading up 2% since the morning, is kind of flatlining now, and year to date is definitely outperforming the broader market. This is like the 3rd largest company in Canada. It is paying a 6.3% dividend yield currently, and just going into why, well, the adjusted EBITDA, guys, is up 15% year over year with Liquid Pipelines. This is the largest pipeline company basically in North America, doing 1.89 billion in sales last year to this year, where they did 2.26 billion. Gas transmission and midstream is up from 986 million to 1.15 billion. They saw a bit of a decline in gas distribution and storage because no one's probably storing gas right now, and renewable power generation went up for the first time here over $100 million for the quarter, which is really, really nice to see. And from a dividend standpoint, it's likely we're going to get an increase probably in December or January. This one tends to do about 1 dividend to 2 dividend increases a year. We're not seeing the same kind of an incredible dividend growth is the next one we're about to look at, but still very, very robust. And at that starting yield, guys, my goodness gracious, this is still a good buying opportunity in my opinion. Let's talk about Telus here real quick, which just posted earnings today as well, trading up 1.3%. Year to date, this one is again outperforming most of the indices, only down 4.57%. You tap on the current 4.77% dividend yield, and you're basically flat for the year. But this sucker, baby, we're getting some nice stuff coming out of here, because firstly, it is an industry-leading total mobile and fixed customer growth of 347,000, up 27,000 over last year, and our strongest quarter on record, driven by higher year-over-year customer growth across our portfolio of leading mobility and fixed services. This thing is just crushing it, and the quarterly dividend increased to 0.3511, an increase of 7.2% over the same time last year. So we just got a really healthy dividend increase out of this one, which is going to take the yield to over 5%. This thing has just been one of the best dividend growth beasts in Canada that Canada has to offer out of the telecom sector. And just taking a look at the revenue itself here, quarter over quarter since forever, this company has been growing mobile network revenues, because obviously, every time someone gets a cell phone, they're either going to be using Bell, Rogers, Telus. There's only a handful of conglomerates, monopolies in this sector. They're seeing growth pretty much across all the spectrums, except for a few things like fixed voice services declined slightly here. They did see a big bump in their health services. It's nice to have exposure to like telehealth stuff. They recently just did a big acquisition, so that's why the revenues probably jumped so dramatically from 137 million to 225 million for the quarter. But Telus, guys, still probably at the tippity top of one of my favorite telecom companies of all time. Next to Bell. Bell is one that I've been fixated on for a little bit just because the yield is pretty much 6%, which is just staggering. And this stock is, well, basically outperforming the broader indices. You take the dividend for the year, you're down 6%, you're basically flat, which is a lot better than being in any of the growth. Or again, the S&P 500 for the year for those people looking for retirement, dividend, cash flow, things of that nature. And just take a look, very similar to Telus, guys. They're posting pretty insane numbers. 224,343 mobile phone net adds. That's up 64.4% year over year, which is record quarterly results. Very similar to what Telus is talking about here. Retail and internet ads up 36.3% year over year, and the best quarterly results in 17 years. It's such a mixed bag of news where we think the market's tanking, huge recessionary environment, yet we're seeing numbers like this. Like digital revenue growth, guys, 31% of total media revenues, up 22% in Q3 2021. I mean, if you know CTV here in Canada, it's the #1 network. Their market share is up 29%, guys. Crave, I don't really use Crave subscriptions, but it's nice to see that's up 7% year over year. Postpaid net ads here from the Bell Wireless, it's up 46.1% year over year. These numbers are just absolutely bonkers. It looks like they had some extra expenditures for Q3, so it being such a great quarter, we can see that their actual net earnings dropped from 813 million to 771 million. I wouldn't be like overly concerned by this just because everything is continuing to grow across the spectrum, so there's probably just some extra expenditure, something to do more due diligence and deep diving on. And from a dividend standpoint, no, we're not getting the same dividend increases we're seeing out of Telus. Telus, I think, is the only one that really increased the dividend. But again, Bell over the last 5 years, basically going from 71 cents to 92 cents. The telecom giants continue to be just absolutely absurd, incredible growth beasts. So across the spectrum here, guys, you got RioCan paying 5%, over 5% dividend, Enbridge paying 6.3%, Telus now over 5% with the recent dividend increase, in Bell paying almost 6%. These are all stocks that I would very comfortably add to my own personal portfolio, and I'd love to know if these are stocks you're buying and what you think about these earnings in that comment section below. But stay cool, stay awesome, and as always, I look forward to catching you in the next one.